Yeah, thanks, Matt. Jedi Options today is going to be a bit of a vocabulary lesson, and it's super important. It may not be the sexiest topic, but I bet every single person listening will learn something from the insights that I'm going to share today. When you trade with a broker, you have to get familiar with their lingo and the cost of trades and tracking things like cost. In Thinkorswim, in the monitor tab, you can monitor your open positions. And sometimes it's a little bit tricky to know how much money is tied up in the trade. Are you using borrowed money? Like, how does all that work? So I'm going to explain today margin requirement. And more specifically, this term margin, because it's used in different ways. And it has different definitions. And I see confusion with this all the time. So I'm going to make it as simple as I can in about 10, 15 minutes and explain what this is. First of all, margin is two definitions, okay? The first definition is it's borrowed money. You are borrowing money and buying something, quote, on margin. For instance, if you have a $10,000 account, okay, and it is a margin account, like when you set up a brokerage account, they ask you what account type you want. They have cash accounts that don't have margin, and then they have margin accounts or accounts that have the ability to use borrowed money. If you have a margin account, by default, most brokers will give you 2-to-1 margin, which essentially means that they'll let you buy up to $20,000 worth of in this case, stock. So on a $10,000 margin account, I would have $20,000 in stock buying power. Now, options do not have the ability to be purchased or traded with borrowed money. The regulators and the powers that be just already assume there's enough leverage as is in options that you don't need to use borrowed money. So that $10,000 margin account would still only have $10,000 of options buying power. I think that's important to know. So sometimes when people say, hey, I'm trading on margin, they mean that they have started to use borrowed money to introduce leverage into their trading. So if I bought $20,000 worth of Apple stock, I'm buying on margin. 10,000 of that is my money. The other 10,000 is the broker's money. As you might expect, when you're trading on margin, when you're trading with borrowed money, the broker is not doing this for the sake of being a good person. They're a for-profit business. They will charge you interest for that margin. Okay. So again, sometimes buying on margin means buying with borrowed money. Other times we use terms like, what is the margin requirement? What is the margin requirement? That is synonymous with what is the collateral that I have to put up to do the trade. You could say, what is the cost of the trade? So in certain instances, somebody's like, hey, my margin requirement was, $400. Does that mean they're using borrowed money? No. Even though they use the term margin, they're not using borrowed money. It's just a synonym for the collateral, the cost, the reduction in my buying power for other trades. How much money is tied up in this trade that is not available in other trades. In this context, it depends on the type of trade you're doing, okay? So if it is a stock trade, typically the margin requirement in a cash account would be 100% of the stock price, okay? If you're in a margin account, it's going to be usually 50% of the stock price, just by default. So if you have a paper money account with Thinkorswim and you say, okay, I want to go buy 100 shares of IWM, that would be about 20 grand. Are they going to make me put up 20 grand? No, even though the cost of the trade is 20,336, they're only going to make me put up half of that. The buying power effect is 10,168. Okay, so oftentimes when we're doing stock trades, the initial collateral or margin required is 50% of the stock price. When you short a stock, your risk is theoretically unlimited. Do they make you put up an unlimited amount of money? Well, of course not. Otherwise, nobody would do it. And so they make you put up a certain percentage of the stock as collateral or margin required. Are you using borrowed money? Not necessarily. Okay, not necessarily. But that's how it works with stocks. With options, it gets a little bit tricky. Remember, you can buy options or spreads, or you can sell options or spreads. When you buy an option, remember, you can't use borrowed money. So if I buy a call for $5 per share, be $500 per contract, the cost is $500. Now, is that collateral? No, it's not collateral. You're not taking $500 and setting it aside. $500 is going out of your account. You bought something. The call comes into the account. The $500 goes out of the account. And so they're not going to like track a change in collateral over time for this long call. You paid $500. It's gone. It goes out of your account. Now you have a call option. If you want the money back, you got to sell a call option. Then the call option goes out of the account. The money comes back in. But there's not like a kitty or a pool of money that's set aside for that call option. You bought it. It's gone. It's out of the account. Same thing if I buy like a spread. Maybe I buy a bear put spread. Okay, for $10 per share, it cost me $1,000. How much money they're going to make me put up? The whole thing, the max loss. You got to put it up at the beginning. So the cost in this case is $1,000. They don't take that and set it aside and keep it in a little box. No, it goes out of the account. The bear put spread comes into the account. It's gone. Okay, so when I build that trade, it's not going to reflect in my account that I have a certain amount of collateral sitting aside for that. And here's what I mean. When you look at the active activity and position statement, there's a column heading that either says margin required or buying power effect. They're synonyms. And when I look at this, let me see here. That's a stock trade. Do I have a long call? I don't. Let me do a debit trade real quick. Yeah, let me buy 100 shares of IWM. All right, I bought 100 shares. Okay, here's IWM. And I should have picked one I didn't have other positions on. At any rate, I've got 100 shares of IWM. What is the buying power effect? Well, it's about half of what I paid, half of the value of the stock. Okay. And so for stock, it shows up that there is margin required for that trade. If I bought a call option, let me go to IBM. We talked about IBM earlier. If I go buy a May call option for $330, first of all, look, the max loss is $345. They're going to take $345 out of your account. Okay. It's gone. You bought it. The money goes out of the account. So when I look at the margin required for the IBM trade, it's zero. They're not holding aside any money in the account. The money went out of the account. So there is no margin required. There's no collateral for purchasing a long call. It's going to be the same thing if you purchase a spread, right? If I come in here to Ford and I buy a bear put spread, I buy an at the money put, and I sell an out of the money put against it. It's a debit trade. It costs 85 cents. 85 cents or $85 goes out of the account. What's the margin required? There is no margin requirement. The money went out of the account. The maximum risk has been deducted from my account. I don't need to put up any more money because there is no more to lose than what I paid initially. Okay. So when this trade fills, it's taking its sweet time here. It's going to show up and the BP effect is going to be essentially zero. Now, it says there's 85 margin required right now, but that's because it's a pending order and it hasn't filled yet. Once this sucker fills, that's going to go to zero. Let me make it a market order. All right, she filled. What's the margin required? Well, zero. Where it gets interesting, and this is the final piece here, is when you sell options or you sell a spread. So let's talk about selling a naked option. If you sell a naked put, usually they only require maybe 10 to 20% of the stock price. So the initial margin required, AKA collateral, okay, AKA cost. The initial cost is usually maybe 10% to 20% of the stock price. And that fluctuates over time, as the stock price rises and falls. Okay, that number can increase. So you got to be aware of that. So for instance, if I come in and I sell a put on GE, which I don't know why I picked GE, but sell a put on GE, okay? The maximum loss is $8,105. Fortunately, they're not going to make you put up $8,105. They're only going to make you put up $847, which is about 10% of your max loss. That is the initial margin required, the initial collateral. If I send this and I go look at my margin required for GE, it's $943 because they're taking that 800 and change plus the premium you receive for selling the put, and it's set aside in a box to cover your risk. That margin required might increase or decrease over time, depending on what happens to the stock. So I want to make sure I have some excess money in reserve when I'm selling puts. It's the same principle with selling calls. What if I sell a spread? What if I sell a put spread? We call that a bull put spread. Okay. So I sell a bull put spread. Is there a margin required? Is there money that's going to be set aside? Yes. Let's say I sell a $5 spread for 50 cents. When I enter the trade, the spread goes out of my account and that 50 cents comes into my account. So I have 50 cents potential profit and I have $4.50 of risk. The broker will take the 50 cents profit and $4.50 of my money, and they'll set that whole $500 in a box. Well, is that going to increase? No, they've already held aside the entire loss. Okay. Could we consider this a margin requirement? I suppose. It's collateral. It's money that you have to set aside. It's margin required. And so that's going to show up on my margin required column heading. So if I take a look at Netflix, which is just disgusting, and I sell a bull put spread. I sell a 190, 185 bull put for 75 cents. The profit is 75. The loss is 425. They're going to make me put up the buying power effect 425. I'll have $425 less after I enter this trade than I have now. I hit send. Let me make it a market order. I didn't need to hit save. Let's just try that again. Here we go. Okay, got filled. What's my margin required? It should say 500 right there, $500. Now, $50 credit or $75 credit and then 425 of my money. Is that number going to fluctuate? No, it's fixed at 500 until you exit the trade. Is the naked put margin requirement going to fluctuate? Yes, it will. Okay. Is the margin on the long stock trade going to fluctuate? Yes, it will, because you're putting up 50% of the stock price changes. And so it's a little bit maybe misleading or tough to grasp this at the beginning. But to summarize, margin sometimes is borrowed money. Most of the time, it's the collateral you have to put up for a trade. And how it behaves depends on whether we're talking about a stock trade or an option trade. And then with option trades, did I buy something or did I sell something? If I bought something, there is no margin required. The money goes out of the account. If I sold something, there will be a margin requirement, depending on if it was a naked option or a spread. That's going to dictate whether it changes or not. Final point, and then back to Matt. You may not have this margin required column. It is also called buying power effect. Matt, I learned this today. I actually have used Thinkorswim forever, and somebody showed me how to do this. You go to set up an application settings, and you go to positions. And right here, it says position margin / BP effect. By default, it's BP effect.
Yeah.
And it's very confusing because it's a negative number sometimes, other times it's a positive number. It's like, what are we talking about here? I would suggest
versus stock.
It is stock versus options.
Yeah.
But it's also confusing because it's like, this is reducing your buying power by 500.
It's how it's listed. It will be confusing to a lot of like traders just because of when we think of how that's listed. One looks like a loss, the other one looks like a gain.
Yep.
And it is confusing.
So if you change it to margin required instead, you don't have negatives and positive numbers. It's a little bit easier to understand.
I've been using Thinkorswim since 09, and I did not know that. Then again, I don't think I've hit the setup button that much.
Usually you figure it out anyways, and it doesn't really matter. But for a new trader, that might be an easy hack there for you.
Well, I was just always taught how to read that because my mentor taught me using Thinkorswim, and so I just was never taught that. But thanks for that hot tip. I appreciate that, Tyler. Really, really much so. See, Tyler, you can teach even old dogs new tricks every now and then.